Good evening, everyone, and thank you for being present on a second day of a conference. I think you've braved the 2 days of conference and yet be here, so thank you for being around. I think as a part of the panel, what we're going to really cover as the topic suggests, identifying opportunities amid dispersion. And just as a background, I think India's been, and I think aligned in that sense to the global economy as the headwinds that the world economy is facing, and India's kind of no exception in many sense. But I think within the stress or the headwinds that you see in the economy, I think you have definite opportunities that we see for global investors. And as a part of that discussion, I think we've got a great panel here. I'll quickly introduce the panelists here to Ketan Patel. He's the founder of Greater Pacific. Again, a private equity firm basically primarily focusing on growth buyouts. We have Parth Gandhi. He's also managing partner with Aion Capital, a distress buyout focused fund, and also a lot of private credit that they've been engaging in. And then we have Kalpen Parekh, part of DSP Investment Managers, formerly the partners with BlackRock in India. So we have kind of a great asset class mix out here to really give you a good perspective of where the opportunities lie. Just to set the background, and I think maybe I'd like to call upon Ketan to kind of give a macro perspective of where you see India stands today in the context of the global economy, and then maybe we can take it forward from there.
Sure. So I had a chance to talk a little bit about this at the Asia panel earlier, but the tension for India has always been China across the other side of the mountains that's been growing so fast and so strongly for over 2 decades, and India has lagged behind. And so out of the research in our team, we looked at what are the metrics that have driven China and what are the metrics for India. And you find actually it's actually quite enlightening. So China took 50 years during communism to struggle and rise to a $1 trillion economy. And then it started the reform process, and in seven years it got to 2 trillion. And the reforms kind of kicked in even further, and in 5 years it got to $3 trillion. That's absolutely stellar, and you'd expect a heavily managed economy to be able to deliver something like that. I would guess most of you think that India didn't do that, but if you analyze India, what you find is India, after the British left, took 50 years to get to a $1 trillion economy. And then in 7 years, it got to 2 trillion, and in 5 years, it got to 3 trillion. So it's almost exactly the same curve, lapsed by about just over a decade. So why is that? And I think herein lies the interesting macro story for India. India's drivers are not China's, but they both share 1.3 billion people, right? So India's drivers are certainly the urbanization. You have, by 2050, the expectation is 1 billion people in India will be living in the cities. But in the next 10 years, 130 million people are expected to join the cities. So you have this mass movement from the rural areas into the cities, which is driving huge demand for infrastructure, for schooling, for education, for digital technologies, for everything. And this is a big movement. You also have the demographics of India, which are very favorable, as we all know. 40% of Indians are considered to be on middle-class income. And in the next 10 years, they think that rises to 80% of the population. So that's an enormous big driver of just people's consumption habits, and so it's again, a big driver. Today, 700 million Indians are using digital technologies and are online. And in the next 10 years, that's expected to grow to 1 billion. And so the drivers are different from China's, but they actually do overlap too. One might be top-down, and in a democracy like India, which is less managed, you're still seeing the same drivers driving the economy upwards. So I think those are the macro, that it's a country with enormous optimism that prosperity is coming. And so you're seeing this driven by the people themselves with some very favorable government policies that we've seen take root in the last 5 or 10 years now.
Okay. And I think, obviously the vision of 5 trillion economy by 2025, yes. and probably I don't know how the headwinds will really kind of affect the timeline that we look at. Do you really see from a macro perspective India as an asset class from a global investing community?
Sure.
How do you think it's kind of really played out for the investing community over the years? And more importantly, I think in terms of the nature of investors that have been participating, and I'll probably just share my perspective. If you really look at the private equity as an asset class over the years, I think the LP base that has looked at India over the years has really kind of transformed in many sense from a relatively more opportunistic investors to someone looking at a more long-term kind of bet on India. Do you see that trend in your business as well?
So I do. We see the first challenge is how do you participate in India's growth? And then secondly, almost equally important is how does the GDP or the overall growth of India, this kind of $1 trillion addition every few years that I've described, how does that translate into a return for LPs? And actually that's been very difficult. India has not developed yet, and it's a nascent stage, sophisticated large groups of private equity professionals, mutual funds and others that are differentiated enough and deliver consistent returns in depth, and so on and so on. Each of the asset classes have not been as broad or as deep. So what you find is there are a small number of players in each of the asset classes that have survived the trauma of India's rise and fall as it goes through this curve. It still is very volatile. Who have the right practices, who look at opportunity but look at risk. So, and I think you have some of my colleagues here are exactly that they've survived the trauma of India collapsing, learnt the lessons, been one of the survivors, and have then seeing themselves now prosper. So if you're an LP and you're looking to choose from 100 players in each asset class, I don't think you'll have that. You'll have a smaller group to look at and figure out how you make your judgment call. And I would suggest that one of the most important factors will be how well do they manage risk, and how well do they protect capital, more so than just where's the opportunity.
No, I think moving to you, Parth, I think you've been a contrarian in terms of your strategy as far as India is concerned, and I think looking at setting up Aion probably about 12 years back, focusing on distressed and stressed assets at that time, and obviously looking at buyouts and some of those opportunities. How's been your experience and journey, and any learnings that you would like to share?
So Siddharth, thanks. And so the way we look at Aion, we look at 3 things. We look at buyouts, that's one strategy. Value-based buyouts, control. The other piece we focus on is hybrid capital, which is essentially private credit. And then the third piece we look at is distress. As you said, we've always looked at life through a contrarian lens. The one thing we've looked at and believe in is the one piece you control is the price you buy something at. That's within your control. Everything else can change. Macro environment changes, global environment changes, policy changes can come through. But if you've bought well, fundamentally, you're protected in some respects because you've essentially bought it at a value which is deep discount. So on the buyout side, that's what we look at. On the private credit side, we're seeing some great opportunities. India as a market is, if you look at credit in India, about 70% of the market was government-owned banks, private sector banks as we call them. Given all the distress that these banks have got on their books, these banks are right now in retreat mode and they're not really growing their lending books. Given that there's essentially a large opportunity for private credit, we look at that. We think that's an asset class which is interesting. The bond markets in India are not developed, so we go out and focus on that as well. And then the last one, as you said, is distressed, which, India's just got this new bankruptcy code which has come through. It has evolved. It's actually a very interesting, very well thought through piece of legislation. It allows for efficient, creditor-driven restructuring of non-performing loans. Is that in perfect shape yet? No, but as in every evolving legislation, you essentially got this change which comes through, and the government and the regulator have been responding very well. As challenges come through, they've been facing those challenges, putting up changes to the law, and doing it very efficiently and quickly. And I think that actually has opened up a very interesting market for distress for control, and even distressed credit. So I think that used to be a place in India where people were worried about, can I enforce credit? We found enforcement of credit and creditor rights in India is actually very strong. As long as you've chosen and gone through the credit structuring well, it actually can be enforced upon. So we found that to be an interesting asset class. I think the other piece which we focused on, and I think is important to us, is look, currency in India. A lot of asset managers don't actually think about hedging, currency hedging. We've taken the tack of saying, listen, hedging is important. The Indian currency does move as opposed to a secular continuous movement. The currency moves, it's sort of like a step function. It drops, and then it does flat, and then again drops down. And if you caught yourself in that middle of the big drop, then you essentially give up a significant amount of your returns just because of the currency. So we've actually, from the beginning, taken a very clear view of saying hedging is important, currency risk needs to be managed. I think Ketan said it rightly. Looking at risk and assessing risk is important. I think with India, the opportunity exists, whether it's buyouts, because the change is coming because Indian families are now selling assets. I look back 20 years back, when I used to invest in India, it was virtually unheard of for a family to actually sell their business. We're now seeing changes come through. If you look at the last 5 years, the number of buyouts which private equity funds have consummated from Indian families has dramatically increased. And that's primarily because of the fact that families are willing to sell their business, monetize, if you will. So 3 opportunities, 3 strategies. We like all 3 of them. I think Ketan said very rightly, picking the right manager is important. A lot of managers out there. Diligence, both for the manager, for the LP, and then from the manager, diligence going into the investment is the most important thing.
Yep, no, I think that's, and I think just to add, I think the distress space has kind of opened up opportunities and not just pure distress investing, but the PE opportunities coming out of kind of hiving off of non-core assets, and I think that creates a great ecosystem for, I think moving on to you, Kalpen, and I mean, it's always a question, and I think everyone looking at the headlines about the GDP growth kind of falling, and then the Indian markets are probably at their peak. And in many sense, I think it confuses investors as to where is this kind of, where does this dichotomy lie in terms of, maybe you want to kind of share your perspective on that?
Thanks, Siddharth. I always tell investors that invest in India not around headlines and news flow and narratives, but instead around a certain framework of investing. And notwithstanding periods of time when the Indian macro story was extremely strong, and then periods when the macro story was slowing down, like it is at this point in time, the key driver for investing, not just in India, but I think in any country, is the company in which you are investing. And recognizing all the growth opportunities as well as challenges, as well as policy decisions in the last couple of years, which have attempted to transform the macro landscape in India, all of this culminates into one data point which mattered the most for capital allocators like you, is how many companies in India can generate return on capital significantly higher than the cost of capital. So in the last 2.5 decades, the cost of capital in India generally has been on the higher side. And in the last few years, in line with the global trends, cost of capital has come down, not as much as rest of the world. The government of India today still borrows at 6.5 to 7%. But if you look at the emerging market landscape, India has the highest number of companies at scale which have return on capital higher than 15 to 16% when the cost of capital is around 7% for the government of India. So I think that is where the opportunity lies on one hand. If we are able to spot such companies with free cash flows and limited leverage in industries which have long runway, the opportunity is large. At the same time, we also recognize that good companies in India have significant promoter ownership, which means the free float is relatively lesser. And such companies attract a lot of capital in times of euphoria and tend to get inflated up. And valuations become challenging in such frameworks. So what we have noted is investing in India needs a framework. It's best to invest. We always tell investors that look at a growth country like India through a value lens in terms of investing when the cycle is slowing down so that you can capture the next upcycle. Flow cycle is also slowing down. Now, in the last 3-4 years, flows into India from global markets have, in temporary phases turned negative or stable to flat, but the domestic flows have improved. So that's another lever of liquidity which is chasing the pool of companies which are capital efficient. And hence, timing the market becomes extremely important. Timing the market at the right entry points, what you mentioned, the price you pay is in your control. All other parameters will have cyclicality and volatility. So what price points on the valuation cycle do you enter? And what price points in the currency cycle do you enter becomes important. And then staying invested for a cycle of at least 6 to 7 years, because that's a full economic and market cycle. These two combinations create healthy returns for investors. The other comment that the headline market is at its lifetime high. Nifty, which is our top 50 stocks, the Nifty stock portfolio is today at 28 times earnings, because the earning cycle is almost at a 7-year low. But within Nifty, if you take the top 10 stocks out and take stock number 11 to 50, the valuation drops to 18 times. So there's massive polarization. And I think this is true across the world. Few companies are winning market share. They are consolidating at the cost of weak companies. The same trend is playing out in India. So when the headline Nifty is at a lifetime high, a lot of quality small and mid-cap companies, tier 2 companies, are at a 2-year, 3-year, and a 5-year low. And they are sitting at a 20 to 40% price correction just in the last 19 months. So you're seeing two different parts of the market. The headline, which is looking extremely expensive compared to its past history, but there's another part of the market which is consolidating, and it is primarily consolidating because of a lot of policy changes that the government is putting in place to build a more long-term, efficient banking system, and all the IBC and NCLT laws which were put in place last 2 years, are creating consolidation. So largely India, instead of being a growth market in the last 7-8 years, as investors have expected, has been a value migration market. So the total market cap remaining intact, there is value migration happening from public sector banks to private banks. There is value migration happening from 15 telecom companies, which was a fragmented market, to only 3 which have left now. So you're seeing a lot of value migration, and hence it becomes extremely important to understand where is the risk and not just the reward. And trying to avoid the risk and minimize the volatility and risk becomes extremely important for investors like you or us to be on the right side of the value migration.
Yeah. No, I think interesting, and I think it's stock picking in many sense. I think a more generalized approach following the index may not have really been the right indicator of how the funds have really performed. Coming back to you, Ketan, in terms of, you've been investing in India for over 14 years, and I think in terms of growth opportunity and growth investing, I mean, where do you see really the opportunities lie? And also maybe if you can talk about some great case studies from your portfolio companies, I think that would be a...
So I mean, we see a few, I mean, that are very important. So one is financial inclusion. The government of India drove a policy to get financial inclusion, and they used a technology to enable it. So the simple answer was they had an ID system where something like 95% nearly of Indians have put a thumbprint down and established an ID in the central ID system. If you look at India's pyramid of 1.3 billion people, you find there's a lot of people in the middle and at the bottom who are unbanked. And so the government set up a system where the thumbprint translates into a bank account in 3 minutes. So nearly 330 million bank accounts were set up in India in the space of 4 years. Now that's a financial revolution almost, right? So the first time bankers who put their money into the bank accounts have already established $20 billion in these bank accounts. So the poor of India had money. It was somewhere else other than in bank accounts, and now it's come into the financial system. This generates a huge amount of opportunity for us as an investor. And so, for example, one of the companies we saw and we're investing in is a business that takes people that have no credit rating, takes all their financial data, and gives them a credit rating, and then gives them a loan, a small loan. It uses AI, machine learning, to actually do this well, and its default delinquency is around 2%. It's been doing this for 5 or 6 years, established that it can do this across different parts of India, and the cultural diversity in India is very great across the country. So you've now got a whole bunch of new and innovative fintech businesses growing up that are being built almost from scratch off the basis of this kind of new data that's available. Second quick example would be mobile technologies. So Indians now have access to smartphones, which are provided largely by Chinese and Korean providers. They're very cheap, they're very high quality, and Indians are transacting through these mobile platforms. So for the first time, you're getting fintech delivered to the mobile phone, and you're getting data analytics. So one of the companies we've invested in takes the data and monitors where you are. So they do it internationally. The Indian cost structure is about 1/7 of the Chinese. So each of you potentially is being tracked by this business. You don't have to have signed up. The fact that you have a mobile phone means they understand your profile. They know whether you're male or female, based on which toilets you went to, which still works in most parts of the world. They understand where you shop, where you live. The value of your real estate is then added to that information. They track how far you came, which hotel you stayed in to come to this conference. They potentially would know whether you go home to sleep or you go somewhere else to sleep before you go home. But privacy rules prevent them knowing you too well. So they're monitoring your behavior as part of a crowd, so that when you go into a retail store, they can give you an offer to transact. And that's the marketing information. There are all these sorts of very, very smart companies growing up in India that are at the intersection of technology, a very large population, a very low cost structure, and either finance, healthcare, or other services. So these are the smart new generation of Indian businesses that we're seeing grow up in India. Very exciting to see them, and they are creating global footprints. So they happen to be Indian, but they're also playing globalization, and they're selling their services into Australia, South Asia, now into the US and Europe and so on. And so this is more the exciting part of India in terms of its growth that I think you can participate in now.
Yeah. Parth, I think coming to you in terms of, and maybe I think for other panelists as well, India is always perceived to be complex, difficult, and I think maybe over the years, that's the perception which has been built in, and I'm sure there are complexities there. And from a global investor perspective, what are the key kind of challenges that you see that they should be mindful of when they kind of build their India strategy?
So yeah, I think there's a couple of things that I find somewhat different in investing in India from other places. So I obviously used to invest in the US for a long time, and one relied on numbers a lot. If you look at it, 80% of your time was spent analyzing the business, and 20% was spent analyzing possibly the owner-operator of the business. I'd flip it around. In India, it's about 80% you spend analyzing the promoter. In India, owner-operators are called promoters, and promoter is a legal term that actually is obligations that promoters have in private companies and listed companies. And I think spending time on that, if you are going to be in a minority investment, that is critical. Governance in India has a lot of value. I'm sure Kalpen will talk about this, which is, I think when I look at listed companies, good governance pays you a few turns more. It just does. Possibly true other places, but much more so in India. So diligence is critical, pretty obvious stuff, critical across the board, but I think in India, choosing the right advisors, picking your diligence, getting it done is important. We look at India from consumption. I'll just talk about one piece. I've seen in India right now per capita incomes just shade below the $2,000 mark. $1,300 roughly goes towards, just your basics, your essentials, your food, your clothing, your shelter. The rest is consumption. That's your essential amount. And as that 1,800 goes to 2,000 and 2,500, consumption is going to go up. So growth inherently exists. You may have periods which are up, periods which are down, but fundamentally, if you look at it over a decade, there is inherent growth in the country. Identifying and picking the right company is the most important. So that's the diligence which I think is critical. That's where I would spend most of my time.
Yeah. And also, I think, obviously, from an exit perspective, Ketan, I mean, India from proving itself as a private equity asset class, generating exits and returns. I think the last year has obviously been exceptional in terms of generating private equity exit. Do you really see that kind of a concern?
I think it is a concern. I think memories are short, right? Most Indian funds you speak to will tell you it's all fine now. It definitely is not all fine now. This is just one part of the cycle. I think the maturity of people, and I think this is true for certainly both my colleagues here, is if you began business in India in somewhere between 2000 and 2007, before the financial crisis hit, you would have bought at a certain valuation, and you would have seen 2008 begin to destroy that. And then you would have seen 2010 to 2014 really destroy that. The Indian currency fell nearly 60% to the dollar for somebody who bought in 2006, 2007. The multiples fell to a third. The liquidity was destroyed. There were no IPOs in the space of nearly 5 years. So, if you knew how to survive that period, protect capital, and at least give it back with some returns, you learn a lot of lessons. I think too many people who arrived after that period feel they were so smart. I think the test of the smartness is the ability to survive these traumas. Yeah. And I think that's the reality of India. So we tend to invest in businesses that have a global footprint, and their revenues are Indian revenues, but more than 50% of the revenues are foreign, and that represents 80% of our portfolio. Essentially, that gives us the ability to exit in a foreign market, not just wait for Indian liquidity. Okay. And I think we have to recognize the reality on the ground to know how to make returns now in India.
No, that's great. I know we are running out of time, but Kalpen, any kind of last thoughts to share on public markets and how do you see the landscape evolving?
So I always feel that keeping in mind valuations becomes very important, and not getting carried away by the narrative and the storyline and the headline. and rather deep diving into the quality of businesses, the quality of cash flows, and what price you pay is a very important dimension. The last comment I will make is, in the last 5 years, the government and the Reserve Bank have worked very hard to earn macro stability, keep inflation low, and that acts as a very strong support for a stable currency. So what has been the biggest challenge for investors globally, which is investing for growth, but currency takes away 4 to 5% of that growth every year. That gets solved when we ring fence the macro framework for India. So the inflation differential between US and India, which used to be 4 to 5%, has now come down to 2%. So 9 to 10% inflation country now, after last 5 years of tight monetary policy, is close to 3.5–4% on inflation. And there's a very responsible fiscal framework in place which does not allow the government to outspend itself, increase fiscal deficits. So I think the last 5 years, while they've been challenging from a price point of view in the market, but a lot of stable frameworks are being put in place to give confidence to investors on the currency approach and on the way one can ring fence promoters and their engagement with the banking system where capital gets exchanged. So these two drivers, I feel, created a lot of turbulence in the last few years, but will put in place an environment which creates a more long-term stable runway for promoters in India as well as for investors.
Yeah, I think with that, I think we've probably run out of time on this one, but I think just to end on a more optimistic note, I think we do see India does present a great opportunity, and I think in many sense that the latest OECD report on the global economic data still suggests that India will be one of the first few economies kind of showing a more positive trend in terms of the GDP growth in the short term as well. And I think that obviously means a lot of structural reforms which have happened, and a large part of that reversal has been credited to a lot of the reforms really kicking in and kind of starting to contribute to the economy in a positive way. So with that, I would like to thank all the panelists here, and thank you and the audience as well for being a patient audience. Thank you so much.
Thank you.